All right, what is up, and welcome back to How to Invest in Commercial Real Estate. Another super awesome, exciting, amazing, very interesting, best How to Invest in Commercial Real Estate show in Tulsa. Best one. I mean, show me another one.
Nothing like hyping our own show.
It's the only one as far as I know, but
that makes it the best.
Okay.
That makes
it the worst.
God, it's very true, unfortunately. Anyway, getting back to the show here, we announced on last week's show that we were launching a new investment offering in Owasso. We've been doing a lot of deals in Owasso. This is our third development deal. It is a ground lease with Bojangles and then a 2-tenant strip center that has Five Guys and Blaze Pizza. Yeah. If you knew, it's hard, right? There's a lot of sites. There's a lot of freaking tenants. But like we're developing shit all over the place. So I know it just takes a minute to register. Right.
So we launched that last week, right?
We
launched it this week.
Can we stay on topic? Yes,
yeah.
We launched it and we filled it in 24 hours. What was the equity raise, Braden?
It was like
940,
950. It was 950 exactly.
950 sold out in 24 hours. So we appreciate all the investors jumping on so quickly and making their commitments. We think it's going to be a really great development. We have great national tenants.
Let's see. We are closing tomorrow on another deal.
Yeah. So we just closed on the Grand Prairie Learning Experience. We just signed the contract on that with Ascend Commercial Builders. This will be our third or fourth project with them. So we're super excited to get that mobilized here in the next few months. Again, that's down in Grand Prairie, Texas. Just closed on that piece of land.
Yeah, nice.
And we have several more of those. I know I keep mentioning, and I always forget to write the names of the cities down. But generally speaking, they're in Dallas, okay? And there's several.
Yep.
So if you like the investment profile, there's a lot.
Yeah. It'll be a lot like the Kiddie Academies we've done. Very similar, single tenant deals.
Yes.
Early childhood development.
Yep. All right. What is our show about today?
Today we're going to talk about considering distressed properties. And so a lot of the deals we talk about are cash flowing properties or even some of these brand new developments. But there's another very profitable part of commercial real estate, and it's the distressed property. So it could be apartments that are being mismanaged. They may be bank owned, foreclosed. It could be a retail center that's got a bunch of vacancy, and maybe it's got an outdated facade or something. It just doesn't look that great anymore. It's outdated.
So let's dig into that, because it's not always just a piece of shit, right? Like sometimes it's a nice looking center in a nice area. It's distressed in the sense that maybe it lost several tenants coincidentally, or the seller couldn't figure out their financing, or it's bank owned. So a lot of the times it's a piece of shit. I mean, which is fine. It's fine, but it's not always that way.
Yeah, and so what we want to encourage you guys today is to always be looking for ways to creatively add value. And a lot of the properties that are distressed, that are bank owned, that are foreclosed, maybe apartments in tougher areas, or retail without a lot of occupancy, is people say, oh, that's headaches, that's problems. And they are problems that you're going to have to go in and solve. But the key is that the competition is limited in those, because not everybody wants problems. A lot of people want to avoid problems. And so you limit your competition, and that increases your potential for getting a good deal or for making outsized profits when you can take on problems and you can see through them to the other side, and you know how to remedy those problems and improve the property.
So do you think, in light of the current interest rates being high, that this could be something that might be more prevalent in the coming months? I mean, Joel, you lived through 2008, 2009 when it was very similar.
Brian, you lived through the 80s when everything crashed.
Braden
we won't talk about all the decades Brian's lived through, but yes, I did make it through.
I've lived through lots of interest rate increases. So what kind of series of events could happen that could lead, in this kind of climate, that could lead to distressed properties? Is it that because of the interest rates, people might have leverage problems right now? Banks might be taken over. There might be some foreclosures. Is that possible in this current interest rate increase?
Great question, Brian.
Yeah, took him a while to get it out, but he got there. He did it.
Yeah, so I think the biggest thing we're talking about here, right, is like the cost of the debt, right? Because the debt has term on it, right? It's typically 5, 7, or a 10-year note, maybe a 15-year note, whatever. Eventually, it's going to expire, and it's not fully amortized, meaning there's a massive balloon payment, right? Like your loan is due, you owe us $5 million tomorrow. So how do people get out of that in a normal situation? Or a normal client is you would either sell or refinance that asset. So you would pay off the old loan with a new loan, or you would pay off the old loan with a sale. Right. So what we're talking about now is, let's just say you want to keep the property. We'll go over both scenarios, but you want to keep the property. You owe, $5 million on it. So it's maybe a $7 or a $10 million asset. And the cost of that $5 million is what? Maybe $200,000 or $300,000 a year. So now that same $5 million may cost you $400,000 or $500,000 a year. So what does that do to the profitability of that center for the investor? It substantially goes down to the point where it may not be able to afford it, and then it's creating a negative cash flow event where the cost of the capital, and then you obviously wouldn't get that loan, right? The loan, the new company, the new bank wouldn't give you that loan because it wouldn't support it. So then you're forced to sell this asset at kind of whatever the market will take. So you're fire selling this asset essentially, again, to pay off your original loan that expired, because you won't be able to get a new one because somebody's going to say, you can't afford, this property can't afford $5 million. We can loan you, $3 million because that's what will meet your debt service coverage ratio of, 1.2 or 1.25 or whatever it is. That's kind of a long answer, but it's really just not being able to afford a refinance. So you're being pushed into a sale to pay off your balloon payment.
Yeah.
Yeah. And your question, Brian, is it's true. We are, because of the high interest rates, I'm expecting us to move into what I'll call kind of an opportunity for distressed assets type situation. If you think back about 2008, 2009, what we had was a really hot real estate market for several years leading up to that, with relatively low interest rates. And so once we had that crash, lending dried up and people couldn't refinance. They couldn't find renters, and it was just a global catastrophe. This is going to be a little different in that I don't see that kind of a crash coming this time. But what we have seen is for the last 15 years, from 2008 to now 2023, is we've had this super hot real estate market and generationally low interest rates.
Yeah.
And so in high increase in rents because of inflation, especially the last 2 or 3 years. And so everybody purchasing, they're like, yeah, I'm getting a 3%, 2.5%, 3%, 3.5% interest rate. And so I can afford a 4.5 cap on my deal, and I can barely make this work. But don't worry, I'm projecting rent growth of 3, 4, 5% a year, so I'm going to be fine. Okay, but what's going to happen is as inflation slows and interest rates rose, now the rent growth is going to slow down, and their 2.5, 3% interest rate is going to come due. And then they're going to say, well, now, like you just said, I can't debt cover with 7.5%. I can't debt cover with 7%, 8%. And so that is going to create opportunities, because those properties are going to be fire sold if they need to be. They're going to get foreclosed on in certain circumstances. Now the bank's going to take them back. The bank will not operate it as well as an owner. And so the occupancy,
they don't have to, right? Because they're trying to sell it for 60 cents on the dollar to recuperate their loan. They don't care about it. Yeah. I mean, if it's a savvy bank, they may try to make a little profit off of it. But at the end of the day, it's like
that's not their business plan.
And they can go after the borrower for any, usually not always, but for any detriment on the loan, any debt that they're still owed. So they can get it on both sides there, both selling the asset and going after the borrower. So I really feel like if interest rates stay high for any longer of a period, if they come back really slow, in the next couple of years, we're going to see some distressed opportunities.
This is why we don't have, this is why all personal, I mean, not all, 99% of home loans are fully amortized. So the average consumer isn't kicked out of their house when interest rates get high.
Yeah. So I'm going to ask you guys a really tough question. Precision has a lot of existing loans. Criterion has a lot of existing loans. What we got to make our investors, we got to answer their question is, what happens to our existing loans here? We did a good job of securing for as long of a term as we could, but I'd like to hear what you guys have to say about that.
Yeah, I'll go first. Precision Equity, we've got on our apartments, we have long-term fixed Fannie Freddie loans. And so I would say,
and those are fully amortized.
No. They're usually 10-year fixed.
Okay.
So 7 years sometimes. And so I think we have one small loan that no investors are on that may be coming due in the next 2 to 3 years. So I think we still have time for interest rates to come back down.
Okay.
But we had that loan for like 10, 12 years. So my balance is really low, I won't have a problem, even if I have to pay more interest in refinancing that asset.
Because the amount you have to refinance is going to be so low.
Pretty low after 12 years of paying it down.
Original, okay.
But yeah, we have been fixing for as long as possible. On the retail side, I think the least amount of years we have left on any of our properties is probably 3. So still, we have runway. And that's why you always want to be considering fixing, when the interest rates are really low, fixing interest rates for as long as you can. In the event they go up, you can weather that storm.
Yeah, if you don't have a prepay on your loan and you're in a good economic climate with good low interest rates, you need to be going to lenders and saying, hey, I want to lock this in now for as long as I can. What's that rate? And in a good climate, you're going to pay a little bit more for that lock, and you're paying for the surety of having that through the
ups and downs of market conditions, for
sure. Exactly.
Okay, so I think that's a good answer. So let's get back to the distressed. Okay, so you said that. So let's say it does go to foreclosure. I'm going to assume, or if there's an owner that really can't afford much, I'm going to assume that because he's going to let the property. He's not going to spend as much in maintenance, probably, right? Because he needs to save money. He knows he needs to save money.
It's obviously a man. Only men own real estate.
He or she. They.
I'm just kidding.
And then I assume if conditions go down, then maybe occupancy might go down because if you're in a bad center, and you across the street, they're giving you the same rate and it's a nicer center, you're going to go over there. So occupancy, I assume, could possibly go down at the same time. Is that right?
So yes. I think that's really well put, because most people, and I think that's why we haven't seen a lot of these opportunities lately, is because it takes a little bit of time. And you kind of describe that from the moment it gets taken over by the bank, or the owner can't afford to the maintenance on it, or the upkeep, or whatever it is, or a tenant starts to leave, so they have some slippage in the triple nets. Then it really maybe goes through a 6, 12, 18-month process of getting run down. Over that period of time, you'll have some more tenants leave, putting more distress on the property and the value. So it's really, within a couple years of that asset going into trouble is where you find opportunity. And again, that's where I think a lot of things, the tide hasn't completely gone out yet.
It doesn't happen overnight. Yeah, it doesn't happen overnight.
So yeah, that's what you have to continue to monitor. And a lot of these deals, you can just do that with your eyes, right? Like a lot of us in real estate enjoy looking at buildings when you're driving down the highway. Oh, what's that worth? What are they doing here? What's going in there? Oh, that'd be a perfect. I do. I kind of think about all that stuff. And when I see what I would consider a diamond in the rough, it's typically something that hasn't had their lawn mowed. They've got this roof that's needed to be repaired forever, or fences that need blown down, or just a bunch of down units or burned down buildings, or retail that you think should be leased. You would be mind blown at the amount of landlords who don't get leases because they have a leaky roof of the space and they just can't afford a new roof, or they can't afford tenant improvement dollars, or they don't pay leasing commissions to the leasing broker, so like nobody really tries to bring them stuff anymore. A lot of the times there's value to be had. And kind of going back to your sentiment in the beginning about headaches, when you're getting involved, a lot of people get involved through distressed properties, through even the base layer of just a fix and flip rent house. Like it's very rare you talk to beginning rental investors or in the residential home space, and they're like, yeah, I bought this rental house, and in 5 years, I'm going to refinance it and do it again.
Yeah. Right.
They never do that. They're like, yeah, I bought this piece of shit. I'm going to go add some value, and then I'm going to sell it to somebody later.
Yeah.
That's what we're doing here. So headaches are your friend. Headaches are dollars, right? Going and fixing this problem that a normal investor doesn't want to deal with. That's where you fit in this puzzle. That's why you made money. That's why you bought this deal. And it's the easiest to do in distressed properties because there's so much value to be added. Upside. And it's all perspective, right? Like, what are you going to do with it? How much money are you going to spend? I could do the same value add deal as you, but spend twice as much money because I think I'm going to generate twice as much money. So it made sense to me. Whereas you said, no, it doesn't need that. I'll just do a little bit and get a little bit more money. So the value is there for you to kind of play around with, but finding the gorgeous center in the gorgeous part of town that doesn't need any work everyone wants to buy that because there's no headaches. It's too easy. It's like a bond.
Yeah.
Yeah. So how do people go about evaluating the numbers on a distressed property? Because, okay, they see a property that looks run down. Maybe it's an apartment complex that's 60% occupied, and it's got 30% of the units are down. They need carpet, they need paint, they need drywall, they need all these things. And so as an investor, you've got to be able to determine what is the price I should pay today. What am I going to spend on all these down units and beautifying the property and getting great management involved? And then what am I going to be able to rent these units for when I get done with all my work? And then how does that translate and through market cap rate into a sale price that I can make money? So that's the pieces that you're putting together. Okay, I'm going to buy this apartment complex for $2 million, and I think it needs $400,000 worth of work, and I think I can increase the rent per unit by $100 a month, $1,200 a year times how many units, and then I can back into a sale price and say, okay, is there profit left over? That's the kind of mental exercise that you're doing. And on retail, it's fairly similar. You want good traffic counts. You want reasonable part of town. Doesn't have to be the best part of town, but at retail is more important to get a decent part of town. And then you got to say, okay, what kind of rent, if they haven't been able to rent the space, so I'm going to have to offer it a lower rent than they've been asking. And how much TI am I going to offer, and what's my leasing commission I'm going to pay? And if I can get tenants in there, what does my NOI go to, and can I make money? Okay. And that's the distressed thing that we're always asking ourselves when we're looking for distressed properties. And we've purchased a bunch of them, both mainly multifamily, but also some retail where we've leased up vacant space and added value.
It's anything on the balance sheet, guys. Like anything going on your balance sheet as far as capital expenditures or improvements into the property, whether it's a distressed value add deal or we're thinking about renovating a property. It's what does this investment on the balance sheet translate to on the P&L? That's it. And understanding those relationships.
Yep.
So going into a distressed property, you need to be prepared to having excess funds going in, right? Like you can't just buy the property. You're adding value. Value is dollars, right? Like value costs money. It costs an investment. So be prepared for that. You're typically going in with some sort of loan to cost loan from a bank, where maybe you're getting loan dollars for your renovation as well because they believe in your stabilized pro forma, and then maybe penciling in some sort of refinance after it's stabilized, right? And that allows you to extract your value while still keeping the property and not generating a taxable event. That sounds like a massive win.
Yeah, and we've done that a few times. Just fix it up, get a new appraisal, refi, pull out cash, pay off your existing note, and take that new cash and go do it again, but you still have the asset. But we encourage everyone, this is a little bit of a slow period buying properties now because interest rates have gone so fast. They've increased so quickly. Sellers haven't adjusted their price, and people haven't really got to the distress point where they're getting foreclosed yet. That is going to happen if rates stay high for, let's say, another year or so. There's going to be those opportunities. So we need to keep our eyes and ears open for those because you're going to want to try to pick those up. I mean, the best buying opportunity of our lifetime was in 08, 09. Money was, printed by buying assets when the market is depressed. Just like you want to buy stocks when the market goes down, not when the market goes up. The same is with real estate. If real estate ever takes a dip, and I think about 08, 09 when properties in Vegas and in Phoenix and in LA were all 40, 50% off. Well, now they're twice, 3 times as much as they were. But nobody wanted to buy in 09. They thought the world was ending. Everyone always thinks the world's ending when you're going through a crash or we're going through a market correction. And smart people bet their money during that time and buy assets. Other people, they keep their money in the bank or under their pillow and they're afraid to take action. But I'm telling you, when the market goes down, when the market corrects, that's where you have to buy.
Yeah. What's the saying? When everybody else is selling, that's when you need to buy.
Yes.
When everybody else is buying, that's when you need to
maybe
sell.
Consider selling.
What do you guys think about the guy that put that massive short on the entire market? The guy that did the 08 housing short?
Oh, yeah.
I did see that article.
Interesting. Thoughts last minute?
I mean, we're due for a correction. I don't know that it'll be a crash like we had, but the market is due for a correction. We've been on a real long bull run.
Yeah, I agree.
All right. Well, that's good for me. Anyway, we will catch you guys next week on how to invest in commercial real estate. Thanks.
All right. Thanks.